Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market breadth and semiconductor analysis. This video presents a direct informational narration of the source document.
Here's our agenda for today. First, we'll cover macroeconomic data updates, followed by AMD earnings and guidance. Then we'll look at NVIDIA technical consolidation, Palantir valuation reassessment, and Intel's speculative market activity. Finally, we'll wrap up with extreme market breadth indicators.
Section 1. Macroeconomic data updates. Geopolitics and key economic indicators.
Starting with geopolitics, recent tensions in the Hormuz Strait temporarily pushed oil prices right up near that $100 mark. But, market sentiment actually stabilized pretty quickly. Why? Well, it boils down to the US and Iran both acknowledging that the existing ceasefire frameworks are still holding up. Plus, the US made it clear that recent actions haven't really crossed the line into needing large-scale military operations, so that's given us a temporary breather on energy infrastructure pressures. Now shifting to the economic front, the US April ISM Services PMI dipped to 53.6. That's down from 54.0, and just a hair below the 53.7 expectation. If we look under the hood at the internal metrics, the employment index came in at 48.0, while the price index stayed pretty hot at 70.7. The business activity index actually ticked up to 55.9, and new orders slipped to 53.5. So what does this tell us? Well, even though these numbers are technically still above the 50 mark, meaning we're still in expansion territory, market analysis suggests that recent energy price shocks might start creeping into core inflation. That could potentially keep core PCE anchored right around 3% for most of the year.
We're also seeing some really interesting contrasting signals in the housing and labor markets. Take March new home sales, for example. They jumped 7.4% to 682,000 units, completely blowing past the 650,000 expectation. But on the flip side, labor demand is showing a steady, gradual slowdown. March JOLTS job openings fell to a revised 6.86 million, and the quit rate just nudged up to 2%. Basically, this data paints a picture of a labor market that's cooling off slowly rather than slamming on the brakes. And that steady trajectory gives monetary policy the room it needs to stay primarily focused on inflation constraints.
Section 2. AMD earnings and guidance. Q1 performance and valuation limits.
All right, let's dive into AMD's numbers. They posted some really solid first-quarter metrics across their core categories. Earnings per share hit $1.37, beating the estimated $1.29. Total revenue came in at $10.25 billion, topping projections of $9.89 billion. Now, the absolute standout here was the data center division. They raked in $5.78 billion, which is a massive 57% surge year over year. Client revenue wasn't slouching either, growing 26% to $2.89 billion, and gaming revenue bumped up 11% to $720 million. On top of all that, their free cash flow saw a really nice expansion, up to $2.57 billion.
So how do we value this going forward? If we model valuation limits based on a 30 to 40 times price to earnings multiple, we get some pretty clear structured price ceilings. For 2026, the upper limit projects out to $272. But remember, the market is always looking ahead, typically pricing in 6 to 12 months of forward expectations. That means current pricing mechanisms are already stretching into mid to late 2027. Under this framework, the absolute maximum top-end valuation is structurally capped at $414 by December 2027. Essentially, if you're seeing prices near that threshold, the market has completely baked in those long-term maximum growth estimates.
Section 3. NVIDIA technical consolidation, price action versus sector performance.
Here's where things get really interesting on the charts. We're seeing a highly pronounced technical divergence right now. NVIDIA's price action is showing a flat consolidation, methodically pulling back to that 196 support level on shrinking trading volume. This is classic behavior for technical indicator repair after a stock has been overbought. But look at the flip side. The broader semiconductor ETF, SMH, has been rallying sharply. Honestly, we haven't seen this severe of a disconnect between NVIDIA and its broader sector index since early 2024.
Now, you might be wondering, does this mean NVIDIA's fundamentals are cracking? Actually, no. This divergence is completely disconnected from any fundamental deterioration. Let's look at the big picture. Core capital expenditures from major tech companies are projected to ramp up from about $750 billion this year to somewhere between $1.1 and $1.2 trillion next year. NVIDIA's market share and its fundamental growth drivers, they are entirely intact. What we're really seeing in the current price action is just short-term liquidity mechanics. Basically, finite capital is rotating out of the megacaps and into smaller cap semiconductor stocks, where it takes a lot less capital volume to generate upside momentum.
Section 4. Palantir Valuation Reassessment, Examining Forward Multiples.
Let's pivot over to Palantir. Even with the recent drop in stock price and some minor upward tweaks to their estimates, Palantir's valuation is still sitting at sky-high levels. If we apply a generous 50 times forward price to earnings multiple, we're looking at a 2026 target of $67 and a 2027 target of $94. But based on recent market pricing, Palantir is actually trading at a staggering 71.5 times its projected December 2027 earnings. Sure, there's technical support down in the 121 to 130 range, but for the stock to return to fundamentally standard multiples, we'd have to see a much more substantial downside correction in price.
Section 5. Intel Speculative Market Activity, News-Driven Momentum versus Fundamentals.
Now let's talk about Intel, because they are currently exhibiting a massive valuation distortion. Right now, the stock is trading at a forward price-to-earnings ratio of 82 times its projected 2027 earnings. Let that sink in for a second. 82 times. That forward multiple totally eclipses even Palantir's stretched valuation. What this tells us is that the recent upward momentum we've seen in Intel is heavily reliant on short-term speculative mechanics rather than actual core financial growth. To really see this fundamental disconnect, we just need to look at their long-term earnings data. Back between 2019 and 2021, Intel was consistently pulling in annual earnings per share above $4. Fast forward to today, and their projected earnings per share all the way out in 2027 is sitting at roughly $1. That's only a quarter of their historical earning capacity. So the recent price jumps we've been seeing, they are strictly news-driven, mostly reacting to speculative foundry partnerships. A real sustained return to peak valuations just isn't supported by the current EPS forecasts.
Section 6. Extreme Market Breadth Indicators, Structural Divergence in the S&P 500.
Zooming back out to the macro level, data sourced from Goldman Sachs is revealing some severe underlying weakness across the broader indices. While the aggregate S&P 500 index has been hovering near record highs, the median stock inside that index actually remains 13% below its 52-week peak. And this structural divergence spans across multiple sectors. The median healthcare stock is down 19%, the median consumer discretionary stock is off by 17%, and even the information technology sector median is down 12%. It's a massive structural disconnect.
Building on that, there is a highly anomalous signal flashing in the market right now. Even though the broader index is technically maintaining bull market levels, over 20 constituent stocks of the S&P 500 are simultaneously hitting their 52-week lows. Think about that for a moment. It is statistically counterintuitive for that many large-cap companies to hit annual lows while the index itself is peaking. This points straight to an environment characterized by extreme internal fragmentation rather than a healthy, broad-based rally.
So, what does this all mean historically? Well, analysis going back to 1990 maps out exactly how predictive this specific breadth condition can be. Normally, average S&P 500 returns over a 1-month, 3-month, and 6-month window are positive, up 0.8%, 2.3%, and 4.8% respectively. But whenever we trigger this specific condition, where more than 20 stocks hit 52-week lows during a bull phase, those subsequent returns completely invert. The historical 1-month return averages a negative 1.3%. The 3-month plunges to a negative 5.3%, and the 6-month averages a negative 4.3%.
To wrap this all up, the objective takeaway from this data is simple. Extreme upward valuation movements are structurally incapable of staying extreme forever. This documented extreme breadth divergence strongly points toward inevitable mean reversion. If you're looking at high-quality, fundamentally sound assets that are currently lagging in price action, the key right now is strictly patience. Because at the end of the day, internal capital rotation remains a fundamental certainty within the market cycle.